If you filled your tank recently, you've probably felt the pinch. But this isn't just a local story. From the United States to Europe, Asia and Africa, fuel pumps across the world are flashing higher prices. And the reason lies thousands of miles away in the narrow waters of the Strait of Hormuz. The conflict between the US and Iran is not just a military story anymore. It just quickly become an economic one, and the shock waves are being felt across global markets. At the center of the crisis is the Strait of Hormuz, one of the most critical energy choke points in the world. Nearly 20% of the global oil supplies pass through this narrow waterway every day. So when tensions escalated and ships began avoiding the strait due to security threats, oil markets reacted immediately. Prices shot up, and when Iran's oil depots were bombed over the weekend, crude surged more than 30% in a matter of hours. At one point, US WTI crude touched nearly $120 a barrel, while Brent crude crossed the $100 mark, something we had not seen since Russia invaded Ukraine in 2022. And when oil spikes, markets panic. According to Bloomberg, the global sell-off that followed wiped out nearly $6 trillion from equity markets worldwide. From Wall Street to Asia, investors rushed to pull money out of the risky assets. The fear was simple: if the Strait of Hormuz is disrupted, the world could face a major oil supply shock. But markets move fast, and sentiments can change just as quickly. Oil prices began easing after the G7 signaled it was ready to intervene to stabilize energy supplies, including potentially releasing oil from strategic reserves. Then came another signal from Washington. US President Donald Trump hinted that the military campaign against Iran would end sooner than expected, saying the operation was very complete and progressing faster than initially forecast. That was enough to calm investors, at least for now. By Tuesday, oil prices had stabilized somewhat. WTI climbed down to around $90 a barrel, while Brent was trading around the same level, still high, but far below the panic level seen earlier. And once oil stabilized, markets began to recover. Across Asia, stock markets rebounded. Indices from South Korea's Kospi to Japan's Nikkei 225 moved higher after several sessions of heavy losses. These economies are particularly sensitive to oil shocks because they import much of their energy through Strait of Hormuz. Pakistan's stock market too, which was the first victim of the conflict, witnessed the most dramatic swings during this crisis, also gained nearly 7% on Tuesday, the most amongst its Asian peers. This comes after the index witnessed some of the worst crashes in its history due to ongoing conflict. Investors were waiting for a positive trigger, and they got one, as attractive valuations and strong fundamentals made the index increasingly appealing. For Pakistan, however, the real challenge goes beyond the stock market. As a net importer of oil, higher global prices quickly translate into domestic pressure. Petrol now costs over 321 rupees per litre, up 20%. Economists say higher fuel costs ripple across the economy, raising transport fares, freight charges, and ultimately the prices of everyday goods. Diesel is particularly critical because the trucks transporting wheat, vegetables, and industrial inputs rely on it. There's also the external pressure. Pakistan already spends between $15 and $20 billion annually importing petroleum products. Analysts estimate that even a $10 per barrel increase in oil prices can immediately add around $300 million to the import bill, with the annual impact reaching up to $2 billion and inflation rising by about 0.6 percentage points. The government has also moved to cushion the impact. Saudi Arabia has assured Pakistan of crude shipments via the port of Yanbu on the Red Sea, bypassing the Strait of Hormuz. At the same time, the Pakistan Navy has launched Operation Muhafiz al-Bahar to secure maritime trade routes, while Prime Minister Shehbaz Sharif has announced austerity measures, including a 4-day work week and reduced fuel allocations for government vehicles. Schools have also been temporarily closed, while universities have shifted to online classes to cut transportation fuel use. The State Bank of Pakistan, meanwhile, has kept its policy interest rate unchanged at 10.5%, warning that the impact of the Middle East conflict will depend on how long the crisis lasts. And that is the key question right now. If tensions ease and oil prices stabilize, markets may continue to recover, rupee will stabilize, and inflation scare will just dry down. But if the conflict escalates, especially around the Strait of Hormuz, the world could be looking at another major energy shock.